What if I told you that gold, the ultimate safe haven, just suffered its biggest fall since 2023, and that it wasn't because of inflation, the Fed, or even a liquidity crunch? No, this time, the crash came from inside the market itself. So today, I'm going to explain exactly what happened, why the drop may not be as dangerous as it looks, and what I expect next for gold and Bitcoin. If you think gold's collapse means the bull run is over, stay with me. You might be surprised. Let's get straight to the question everyone's asking. Is this fall in gold prices something to worry about? Has the uptrend ended? Were we wrong about gold's long-term potential? To answer that, I'll walk you through what's really driving the market, not the headlines, but the underlying forces of debt, liquidity, and trading mechanics that very few people talk about. Let's start with something simple. Governments will keep spending. Public debt isn't slowing down, it's exploding. We're living in a world where there's a massive sovereign debt bubble. And to keep that bubble rolling, governments and central banks must inject liquidity into the system. So, logically, liquidity will continue to grow, even if it pauses temporarily here and there. Some people think gold fell because liquidity is shrinking, but that's not true. Global liquidity is still increasing, largely because the People's Bank of China keeps injecting capital into the system. So, no, this drop in gold isn't about tightening liquidity. Let's dig deeper. If we look at the US dollar, it's still in a downtrend. That's another sign that global liquidity remains loose. And when we check the MOVE index, a measure of bond market volatility, we see it bounced from 70 to 80, and now it's back near 77. That's well below the panic levels of 2021 and 2022. So, again, liquidity is still comfortable, which means this isn't about fundamentals collapsing. So why did gold crash so hard? The answer lies in the structure of the market itself. Gold had gone parabolic. Sentiment was extremely bullish. ETFs saw record inflows, and RSI readings hit historic overbought levels. So, after such a euphoric move, a sharp correction was almost inevitable. But the real trigger was options positioning. In the $4,400 zone, many traders sold call options expecting a pullback. Dealers who bought those calls had to hedge by selling gold futures. Then, the critical moment. A key uptrend line connecting the October 10th and 14th lows was broken. That triggered stop losses. Longs were forced to sell. Some even bought put options to hedge. And as those hedges kicked in, dealers had to sell even more futures automatically. The result? A cascade of algorithmic selling. Not panic, not fear, just math. A mechanical sell-off, not an economic signal. So that brutal fall you saw wasn't about gold losing its shine. It was dealers executing automatic sell orders without caring about price. That's why, as soon as the market stabilized, those same dealers began buying back the futures they sold, and we're already seeing the rebound. Here's my view. We've already seen the worst of the drop. Gold is now likely to move sideways, searching for a pivot zone, the midpoint of this trading range. This kind of decline, around 5 to 6%, is rare. Since 1971, we've only seen about 34 similar cases. And in almost every one, the long-term trend remained bullish. Yes, there was one exception, 2011. That drop led to years of stagnation before gold broke out again. But the pattern we're seeing today is not the same as 2011. This time, it looks like a technical correction after extreme optimism, not the start of a bear market. Now, let's look at something fascinating. The relationship between gold and Bitcoin. Whenever gold corrects sharply, short-term speculators often move their capital to assets that look oversold. Right now, that's Bitcoin. I've plotted a chart showing Bitcoin priced in gold, Bitcoin divided by gold in US dollars. And here's what's interesting. The chart shows an uptrend line connecting the 2019 and 2022 lows, and Bitcoin is sitting right on that line now. This is a logarithmic scale, not linear, so this support is significant. If this level holds, Bitcoin could begin to outperform gold again and push toward its resistance, the highs from 2021 and 2025. If that breakout happens, we could see a powerful new move higher in Bitcoin relative to gold. So, while gold might move sideways, Bitcoin may start leading again. Let's step back. If global liquidity keeps rising, and it probably will, then both gold and Bitcoin should continue trending upward over the long term. Short-term volatility doesn't change that structural picture. The world is still flooded with debt, governments are still spending, and central banks will keep providing liquidity. So, my long-term targets remain. Gold around $5,000 an ounce, possibly $10,000 in the coming years. Bitcoin outperforming as speculative money rotates in. This correction was painful, yes, but it was also healthy. It cleaned up excess optimism and gave the market a chance to reset. So no, gold hasn't lost its shine. It's just catching its breath. If you want to keep following these kinds of in-depth market breakdowns, where we separate noise from data and emotion from logic, make sure to subscribe to the channel and like this video. It helps more people discover these analyses and keeps this community growing. Thank you for watching. Stay calm, stay informed, and as always, trade smart.